Morning, everybody. It's 8:39 on this Monday morning, first day of the new quarter, October 2nd. What was interesting this morning was the fact that normally we don't have much in the way of economic news on Monday mornings. But today we have at 9:45 the S&P Global U.S. Manufacturing PMI, which is a final number for September. At 10 o'clock we have the ISM Manufacturing Index, also for September. Um, and we have construction spending at 10 o'clock for August. It is a busy week. We have JOLTS, we have ADP, of course, we have Fridays, non farm payrolls, private payrolls, hourly earnings, unemployment rate, average work week, and always my favorite at 3 o'clock on Friday, consumer credit, which is, I have to say, I'm expecting to be horrendous again. We're well over $1 trillion in consumer credit card debt, and so that can't be good. And I want to point out here, for those of you who are newer to trading, as opposed to the old farts like me, um, the lesson of the bonds is really simple. The bonds right now have absolutely nothing to do with the economy. I mentioned in last night's narrative in the weekly letter that, you know, what's really unusual here is that if you look at interest rates, it's kind of juxtaposed against the fact that rising interest rates are usually a sign of a good economy, and demand for money. That is not the case here. The economy actually kind of sucks. And those lying bastards in Washington will be the first to reconfirm all of those lies just by their actions. Um, Jared Bernstein, who never saw a Biden policy that he couldn't get overly excited about like a little girl. Everything is always great. Everything is always perfect. You know, he's no better, no worse than Trump, as are most politicians. In any event, the point that I'm making about interest rates as they continue to rise is that it is the clearest example of supply and demand. There is a monstrous amount of supply. The biggest buyers are at odds with us. China, for example, um, and a great deal of Russia, of course, Russia, but a great deal of the EU countries. But more important than that, as I mentioned last week and again this week, Japan is the biggest holder, and they're getting pounded. Think back to duration risk, which is what happened at Silicon Valley Bank, First Republic, Signature. All these banks were out on the duration end of the market, meaning the period of time they were in, what they were in. They were in the 10-year, they were in the 20-year, they were in the 30-year. Those are the biggest pieces of financing of our incredibly extreme amount of debt as a country. There's nobody left to buy them. That's why rates are up. not because there's demand for money. The only demand for money right here is by those jackasses in Washington to finance our 33 plus trillion in debt and our continued deficit spending. So it's getting worse. It's going to get worse, and it has little, if anything, to do with the economy. As far as news around the world this morning, we have Asia mixed and Europe down. We have um, China, South Korea, and India closed for holidays, meaning, the markets will get a little on the thin side. Shanghai is closed, COPSI is closed, and also Australia. So, what we do have this morning is Chinese September manufacturing PMI was 50.2, if that's actually true. Non-manufacturing 51.7 was expected 51.5 anyway. Um, what we have is their manufacturing PMI again in expansion, but Japan's manufacturing PMI moving deeper into contraction. If they were being honest about it, which they have never been, Japan has always been somewhat of a rig market, and the reason I say that is because they don't mark to market. So all of those treasuries that are going down, price down, rates up, are being carried on the books probably at par, and they're not worth anywhere near that. So we'll have to see what else is going on. Rivian upgraded to outperform from inline at Evercore. NVIDIA, Goldman Sachs added to the stock conviction list. FedEx up $2, upgraded to positive from neutral at Susquehanna. Discovery Financial, $90 up 3.5. Disclosed on Friday night that the FDIC issued a previously disclosed consent order addressing the shortcomings of Discovery Bank's compliance and management systems. And Clorox up $1.50 after a pretty ugly week last week, and ugly news about it. Upgraded to buy from neutral at DA Davidson. Um, in any event, we also have the futures, which last night on the news of the deal, Saturday night to Sunday morning, um, the futures were strongly higher. The S&P, which right now is down about $8, was actually up $30. So, down 8 from up 30, that's a $40 swing from positive to negative. I was kind of hoping we would open higher so that we could buy some of those SPSX calls, the leveraged inverse S&P. We have the Dow, which was up almost 200 last night, is now down 81 and a half. I've seen it down as much as about 100. NASDAQ is sharply unchanged, went from up 7 to currently down about 6. So there's really not much going on there. And, expect more bullshit from Washington. Expect more people like Jared Bernstein and Mohammed Al-Arian. The old expression, um, when you're a hammer, everything looks like a nail. Mohammed Al-Arian never saw a market that he couldn't get excited about from the negative side and have to warn us over and over and over again. I'm not saying that he's wrong. Just saying that it gets kind of boring listening to exactly the same argument over and over and over again. Okay, chart on the screen is the bonds, and it is a very long term picture of the bonds. This is 1978. So the bottom here in 1981, in September of 81, um, with bonds selling for 55 cents on the dollar, started to the upside, and that market lasted from 1981 to 2000. Let's go right to the peak. This is March of 2020. So, you're talking about almost a 40-year bull market. Guess what, folks? The trend has changed and things are tough. And the only reason that I'm looking for a bounce is because the RSI has double bottomed here and is very over sold. The MACD is turning to the upside, but the most important issue here for me is you see this purple line in here. This is the open interest. When the open interest is going up and the price is going up, that is people buying. More buying, higher open interest, direction up. However, now that we've broken out again, as we've broken to the downside, this looks as if we're getting new short positions. Higher open interest, more open contracts, price going down while that's happening, new short positions. If it was people just selling out and liquidating bonds, then the open interest would be going down, not up. And I want to just take this back to the weekly, and let's go with the 4-year, because I want you to see that after the trend turned, after the blow off high, and this is in last night's letter, blow up, break, lower high, lower low, lower high, lower low, lower high, much lower low, lower high, consolidation, lower high, break, rally back to the point of break, break again, rally back to the point of prior support, break, lower high, lower low, lower high, lower low, new break. This market, as I showed you, this market has not been down here since 2007. And I know that we know what happened in 2007 and 2008. Um, so it's hard to get excited about it with a change in trend. But on the other hand, we could easily get a move back to the point of break here, still have a lower high, still be below this trend line, and we could have a move. We're trading at 113 right now. We could be 118, 120, which is a substantial move. As I said, oversold, RSI turning up, MACD already turned up. Looks like we could have a move here. Be careful out there, folks. I'll be back tonight. And by the way, if you have the time, you don't have to watch it all at once. But my interview done on Zoom with the Brazilian markets, not my analysis of Brazilian markets, an interview with someone from Brazil with about 45,000 followers. That was released on Friday evening. Take a look. It's pretty broad reaching. Have a good one, folks. Be careful out there.